Let's kick off with what is a REIT, or Real Estate Investment Trust. Simply put, it is a company that owns income-producing real estate or assets. This could include an office building, malls, hotels, warehouses, hospitals, and ports. Another important aspect is it is profitable. Generally, it pays a lot of its profits as dividends. In fact, a REIT must pay out at least 90% of earnings as dividends in order to enjoy incentives such as lower income taxes. Part 2. Why buy a REIT? First, it democratizes ownership of a property. Ask around, how much does it take to build an office building in Makati or Alabang? I would peg it at a few billion pesos. How much does it take to build even a small hotel? Perhaps a few 100 million pesos. Investing in a REIT gives you the economic benefits of owning a property or a property asset without the headache of management for a very small amount of a few hundred or a few thousand pesos. Second, it gives you yield. Listed REITs in the market currently offer a dividend yield of between 4.5% and 6%. This beats the average annual inflation of the past 5 years of around 3%. It is even above the competing instruments such as a 10-year Philippine government bond, which yields around 3.9%, and a 5-year time deposit, which pays around 2.3% per annum. But wait, there is more. Not only will you obtain a yield, you will get the possibility of capital appreciation. Make no mistake, REITs do offer growth. We note that an equally weighted basket of Philippine REITs in the past 6 months is up 12%, outperforming the Philippine Composite Index's gain of around 2%. The goal of most REITs is to add value, grow its asset base, rather than sit still. So with most REITs, there's a possibility of higher income through rental escalations, improvement in occupancy, and most importantly, acquisitions. Finally, the fourth reason to buy a REIT is it's liquid. A REIT will trade on the Philippine Stock Exchange or PSC. This means it is easy and quick to buy or sell out of a position. All you need is to call your broker or enter a trade through an online account in BPI Trade. Part 3. What to look for in a REIT? First, you have to look at the economy. Current and projected GDP growth expectations tend to drive decisions about whether to rent more space. You have to ask, are firms or the likely tenants of the REIT willing to invest in the country and expand operations? Another thing to watch out for is the industries or segments that the REIT services. How is the supply and demand for the types of properties that the REIT offers? Strong demand from key tenants such as BPO operators, all things equal, will give landlords more bargaining power. In contrast, more supply in the face of weak or lackluster demand shifts the power to tenants, meaning they can bargain for a better deal and ask for lower rents or lower rate increases. Another thing to look out for is location. Are the properties located in areas that are expected to appreciate? The attractiveness of the location tends to increase the land value and likewise increases the REIT's ability to raise rents. Other factors that could influence the attractiveness of the location include the availability of mass transportation nearby and the amenities and facilities offered by the properties. Another thing we can look out for is the clients and tenants of the REITs. Are they financially stable, meaning they can meet the rental commitments and potentially renew their leases? Are the tenants operating in less volatile industries and committed to investing in the area or country long term? Another aspect to pay attention to is the pipeline. Check on the sponsor, effectively the majority owner of the REIT. Does the firm have a deep and extensive pipeline of assets that can be injected into the REIT? This could include undeveloped land, revenue-generating buildings. Typically, a stronger pipeline gives investors assurance that there's a runway to achieving growth. Finally, review the structure of the contracts. Investors typically look at a figure called WALE or WALE, which is the weighted average length of contracts until expiry. All things equal, longer contracts lend a higher level of predictability, which investors like. Unless rental rates are expected to spike dramatically in the short term, most investors would prefer that for the foreseeable future, the properties will have stability in terms of tenants and lease contracts. Longer contracts, of course, also reduce the possibility of a worst-case scenario, which is the prospect of lower rents and subsequently a potential drop in revenues or earnings. We hope this video gave you a greater appreciation for REITs and why they could potentially be worthwhile investments for your portfolio. Again, the decision on investing will depend on your risk profile and time horizon, among other factors. Thank you.